Hey everyone, this is Gendlin with Real Estate Skills. In today's video, we're going to be talking about what are capital gains taxes, how to avoid and reduce your capital gain taxes legally, and also what are some strategies that you can use to minimize them if there's no way to completely avoid them legally. So make sure to click on the link in our description for more information, get our resource, like, subscribe, and comment for more content. First, let's talk about what are capital gains taxes, when do they occur, and how to reduce and or avoid them. First, capital gain taxes are taxes that you pay when you sell a piece of real estate. Now, if you own a piece of real estate for more than 1 year, you pay long-term capital gains. When you sell real estate that you've owned for less than 1 year, then you pay short-term capital gains, which are basically your income tax. So what that means is if you own a property for more than 1 year and you're in the top tax bracket, that means your capital gains tax when you sell that property is going to be 20%. So we got this information from IRS for the latest tax rates. If you sell a property for a short period of time that you've owned less than 1 year, then it's going to be taxed as your regular income tax. So if you're in the top tax bracket, you're going to be in the high 30 percentile on your tax rate. So that means if you own a property for 10 months and you're close to that 1 year, it might make sense just to hold it for 2 more months. Then your capital gains tax might be reduced by almost 50%. That's why it's important to understand the difference between long-term capital gains and short-term capital gains. Sometimes renovating and selling a property can take almost 1 year. So if you're close to that 1 year period, it might make sense to wait that extra month or two and sell the property after that. If you want to read more about that, we'll include a link down below to the IRS's website so you can get all the details. So when exactly do you pay a capital gains tax? Pretty much the only time that you can avoid paying a capital gains tax without doing what's called the 1031 exchange, which we'll talk about in a second, is if you've lived in your primary residence for at least 2 years, and then you've sold that house and you made a profit on it. If you're single, you can keep up to $250,000 of the profit from that sale without paying taxes on it. If you're married, you can keep up to $500,000 of that profit without paying taxes on it. That is the only exclusion when selling your personal residence, which you don't have to pay capital gains taxes on. Otherwise, if you're a real estate investor and you're selling a fix and flip property or a wholesale property, you have to pay either short-term or long-term capital gains. So here's 3 things that will avoid how much capital gains you will pay. Number 1 is your filing status. Are you filing jointly or with someone else? Again, if you're married, you can make up to $500,000 on the sale of your personal home and not pay any taxes. As a single person, you can make up to $250,000 in profit without paying any taxes on it. The next thing is the type of home it is. If it's your primary residence, again, what we talked about applies. $250,000 for a single person on a sale, $500,000 for a married couple on a sale for a home that is your primary residence for 2 years. If it's an investment property, you pretty much have to pay either long-term capital gains or short-term capital gains based on how long you've owned that property. And finally, the length of time affects what your tax rate is going to be. More than 2 years on a personal residence, you are paying no income taxes on that first portion of profit. Less than that 2 years, basically any money you make on the sale of your home goes towards your total income for the year, and whatever tax bracket you fall in, that's what you pay taxes on. On your investment properties, it counts if you've owned it for more than a year, you're going to pay long-term capital gains. If you've owned it less than a year, you're paying short-term capital gains, which again goes for your total income for the year and counts in whatever bracket you fall into. That's the amount of tax you will pay. Let's talk about a couple of quick tips for the 121 home sale exclusion. Number 1, you have to have lived in your personal residence for at least 2 out of the last 5 years during the time for which you sell it. So when you sell a home and you want to claim this exclusion and not pay any taxes on the money you received, you have to have lived there for at least 2 of the previous 5 years. This is something that's really recommended to people that are younger and can easily move from home to home, and it's a good way to increase your income every 2 years and not pay taxes on it. This is something I've done a lot when I was younger and something I recommend for families that don't maybe have any kids and can easily move from home to home and get a nice profit without having to pay taxes on it. Next, for our real estate investors out there, let's talk about the 1031 exchange. What the 1031 exchange is a government tax rule that allows you to sell a property and take the profits from that property and roll it into another similar property. So if I sell a multifamily property and I make $500,000, I can use that $500,000 as a down payment or buy another property in cash, that's similar type of property, multifamily, to continue rolling my profit, getting bigger and bigger deals. Now, one of the things to note about that is when you sell a property, you have 45 days from the date of the sale to identify your next investment. After that 45-day period, you have a total of 6 months to close on that investment. And when you sell that investment property and make your $500,000 profit, as an example, that money does not go to you. It goes to what's called an intermediary. This is a company or a person that will hold that money until you identify and close on another property. So part of this 1031 exchange process is that money can never come to you if you plan on rolling it into another investment. But let's say you want to take some of that money out because you want to live off that money, but you don't want to pay taxes on it. One great strategy is to buy a property with that cash, either as a down payment or buy it all in cash. And then you can legally go get a loan from a bank and refinance that property, getting some of that money back to you as a loan. And because it's a loan, it's not profit that you still owe back to the bank. You're getting a portion of your profit back to you completely tax-free. That is an awesome strategy, how to take money from the profit of a sale of a commercial property or a multifamily property, roll it into a new one, and then use a bank loan to get some of it back in your pocket completely tax-free. So now you know how to legally avoid capital gains taxes on the sale of real estate. We talked about the 121 home sale exclusion and the 1031 exchange. If you want more information, get our resource down below. Click on the link for more information. Like, subscribe. We'll see you in the next video, and happy investing.